Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to another episode of Bloomberg Deals, the only show dedicated to the corporate action reshaping markets. On this episode, Bloomberg reporting that United Airlines CEO Scott Kirby has floated a possible combination with American Airlines. It's a deal that would test the limits of this deal-friendly administration. And we speak with Vinod Khosla, founder of Khosla Ventures. We're going to talk about AI valuations and the big picture as he sees AI adoption increasing. And Hollywood actors push back against the Paramount-Warner Brothers acquisition. Over 1,000 are speaking out against the deal. And we start with a possibly huge deal, and that is the United Airlines CEO floating a tie-up of a monumental size. Bloomberg telling people familiar, which includes the people around this table with me, that Kirby pitched a possible combination with American Airlines to senior government officials. He reportedly also directly pitched President Trump on the idea during a meeting in February. Sid Phillip covers airlines for us and joins us around the table alongside Michelle Davis from our Deals team. Great to see you both. So Sid, on this deal, I gotta say, it sounds crazy, this idea that something of this size could ever happen.
It does, and on the face of it, this would be the largest airline on the planet and would have over a third of the market share in the country. It would basically have 2,800 planes. I mean, that's monumental for an airline to have so many planes, to have so many routes, to have so much market share. And so it will really be a test for regulators and lawmakers and everybody else to see whether or not this actually goes through. Is
this also just a big flex from United when everyone's worrying about fuel prices going higher because of the war? He's talking about buying American Airlines?
It is. It sort of shows the position that United's in. I mean, United and Delta Airlines have cashed in on that premium customer in the rebound of demand since the pandemic. And that customer has been more resilient than those looking for the sort of deals and the discounts, and that's sort of been where United and Delta have made most of their money. And so for them, they're in a much stronger position, and they are sort of flexing that muscle at a time when other airlines are feeling weaker, especially because of higher prices.
And in other deal news that the team has been reporting on, Michelle, I know that you've also been reporting that Amazon is in talks to possibly acquire a satellite company, Globalstar. What did you learn about that possible deal?
Yes, the deal officially announced tomorrow, and it's part of Amazon's ambition to really be a leader in providing satellite cell service, basically, or satellite broadband service. SpaceX's Starlink is obviously the true leader in that. Amazon has had a bit more trouble getting their effort quite literally off the ground. You know, they haven't been able to launch as many satellites into orbit as SpaceX. What this deal does is it gives them really valuable spectrum that Globalstar has, which basically means Amazon's now going to be able to offer something called direct-to-device, which is, you know, if you're on a hike or you're driving and you suddenly lose service, you'll be able to beam into Globalstar or Amazon Now's satellites and do text, talk, data. So this is something that really helps them kind of play a bit of catch up with SpaceX, but you know, for them to really catch up, they'll have to launch some more satellites.
By the way, I love that they literally haven't gotten off the ground. I feel like every single day when we hear about an Amazon deal, it's usually something around AI. So you add this to their arsenal. I mean, how much money do they have that they can keep spending? What are valuations like? Is this easy for them? Can they keep issuing bonds in markets, allowing them to finance these types of activities from Amazon?
Well, I mean, and Amazon isn't that acquisitive. When you think about it, this is only their second biggest deal ever. It's their biggest since they bought Whole Foods almost a decade ago. But, you know, there are a few companies that are as big and as diversified as Amazon who have someone like Jeff Bezos, you know, multi-billionaire, obviously. And we heard that this process was actually really competitive. Last year, we reported that SpaceX also took a look at Globalstar. At the time, we were hearing Globalstar wanted at least $10 billion to sell. And now Amazon struck this deal for $11.6 billion. So clearly, you know, they're doubling down. They really want to be a leader.
Great reporting, both of you. Thank you so much for joining on today's show. That is Bloomberg's Michelle Davis and Sid Phillip. Now, for these overall markets, it was a volatile first quarter, and it meant that there was record trading revenue on Wall Street banks for the first quarter. But maybe more importantly for this show specifically is the momentum in their deal-making business. Bloomberg's Scarlett Fu has been digging through the numbers and has a wrap-up for us. Scarlett.
That's right, Danny. The six biggest banks indeed did see a comeback in deal-making. A common theme that emerged was that debt and equity underwriting often missed estimates, while M&A advisory rose more than expected. Not so at Goldman Sachs, whose bankers currently rank #1 in the M&A league table. The firm posted an almost 50% increase in overall investment banking fees. JP Morgan recorded $2.9 billion in investment banking revenue with nearly $1.3 billion in M&A fees. That's an 82% jump, while Morgan Stanley's investment banking fees increased 36% to $2.12 billion. As for the outlook, Goldman's backlog of investment banking fees decreased slightly from year-end. But the CEO, David Solomon, said public offering activity will rebound once conditions stabilize. And according to Bank of America's CFO, it remains a good deal environment. Citi's CFO agreed as well, saying that the start of the second quarter was helped by a few transactions that were bumped up from the preceding period, but warned that if the Iran conflict remains in place for a very long time, that could impact M&A in the second half of the year. And here's what Morgan Stanley CEO Ted Pick told us exclusively earlier today.
If the conflict can be boxed at some level, would we expect the coming to the market of these great companies, but also smaller, very high-quality sponsor companies to either come via IPO or to engage in the M&A trade that has been sort of the logjam the last couple of years. And I think we're seeing in pipelines that both corporates and sponsors want to come.
Danny, deals are certainly back in focus for the big banks.
Yeah, they really are. And Ted Pick making a good point there. The M&A, the record first quarter, it was all about corporate strategics. Private equity wasn't really participating in that, so we'll see if that changes. Scarlett, thank you so much. Now, banks this week have also been commenting a lot on private credit. And is some of the logjam breaking? Pimco bought the entire $400 million Blue Owl deal at 6.5%. At the same time, Goldman Sachs raised $750 million in a second offering. It's the latest sign that demand is back after months of redemption pressure. It was only a few weeks ago, though, that I spoke with the Pimco CEO, the Pimco president, Christian Strack, who joined expressing his caution about what he was seeing sold as loans.
A lot of the loans that are out for sale right now are pretty bad loans. So, we've seen some blocks of those, and they're not clearing at a price where we would be interested in buying them.
And we're joined now by Olivia Fishlow, and she covers private credit for Bloomberg. Olivia, what a difference a month makes. I mean, Christian there saying nothing looks good on the market. So what is this? Were prices just attractive enough? Did something change about these loans that Pimco decided to snap them all up?
Definitely, yeah, it's a good question, and I think what we're seeing for private credit is the structure really matters. So maybe he didn't think, going out and buying individual private credit loans was a good opportunity, but oh look, Blue Owl's in the market with bonds for their BDC. Maybe that's a good chance for us to buy those and sort of mitigate some of the risks there, but still be a player in the market. And
I mentioned Goldman Sachs also doing the same to meet redemptions, not buying, but rather selling. So for these funds who are needing to meet their redemptions, even if it's in the case of Goldman just below that 5% gate, are they finding a market that is receptive to that, an easy time to get that liquidity?
It seems like they are so far from what we've seen. For the Blue Owl sale, it was the first in 6 weeks, so I think it was sort of a test of the market. But it's important to note that was their publicly traded BDC, so I think as some of these non-traded BDCs come to the market, we'll have to see how demand goes for them.
And we'll have you back on to discuss them. Olivia, great reporting. Thanks for joining us. That's Olivia Fishlow of Bloomberg. Coming up, we talk about the next frontier in AI with Vinod Khosla, founder of Khosla Ventures. He joins us from Citi's 4th annual AI Summit just outside of San Francisco. And as we continue taking a look at the IPO market, McCormick CEO Brendan Foley spoke last week to us about its merger between Unilever.
You have two iconic brand portfolios combining to really create just a preeminent, food company that's all focused on flavor. Both shareholders win in this. What they get is a larger food company that's faster growing with stronger margins and an ability to really build out globally.
VC is reportedly rushing to offer investment into Anthropic. Business Insider reporting that in recent weeks, we're reporting in recent weeks that the value of the company could be up to $800 billion. On the other hand, the Financial Times reporting that some backers of OpenAI are scrutinizing the company's $852 valuation. Part of all this buzz is fueled by the Silicon Valley view that the tech could usher in an era of abundance and fundamentally change the economy, not to mention a possible IPO from both of them. For more on that big picture, we're joined by Vinod Khosla, founder of Khosla Ventures, and he's live at Citi's 4th Annual AI Summit. Vinod, thank you so much for joining us. And look, you know these businesses better than anyone. You were one of the first investors, real institutional investors in OpenAI. In recent days, there has been this question, $852 billion. Is that too punchy of a valuation from OpenAI, especially as they try to maybe do the strategic pivot away from consumers into enterprise businesses?
I don't think it is. I think these businesses are growing so rapidly. And more importantly, it's so much dislocation to the traditional business world that it is justified to create large amounts of value and large amounts of investment in the category.
What do you think of that strategy shift, Vinod, this idea of OpenAI? Because it already has this really big hold on consumer. Does it make sense to try to refocus on enterprise like Anthropic is doing?
I do believe both companies have always been focused on enterprise. OpenAI has never not participated in enterprise, and it has been growing very rapidly, so not surprising that both want to focus. OpenAI is also in the consumer side, as is Google. So not to count out Google. Google is both on enterprise and on consumer.
It's a good point. It does feel like we're in a bit of an arms race ahead of potential IPOs. And I have to ask you about this because you are speaking to me on Bloomberg Deals. Is it important, do you think, that OpenAI gets out in front of Anthropic and lists before them? Would you advise Sam and Sarah to kind of speed up, press on the gas pedal, and make sure they can get to market sooner rather than later?
My personal view doesn't count as much, but I don't think timing matters. What matters is fundamental product and product momentum and product capability. I think it matters less who gets out first. By 2028, it won't matter who was first. What will matter is who has the best models, the best technical capability, and the most revenue and momentum.
Vinod, can I just be clear? If anyone's opinions matter in this, it's absolutely yours. So I'm happy you shared it with us. There's also been reporting that after Anthropic's Mythos model, that OpenAI says they have something similar, that they're rolling out to a select group of people. Have you seen any of this? They're calling it the GPT 5.4 cyber. Have you seen it? Does it seem as advanced and maybe as kind of like scary as the Mythos model from Anthropic?
Without being specific, what I would say is these three companies, Anthropic, Google, and OpenAI, will keep leapfrogging each other for the foreseeable future, in my view.
The other maybe interesting thing that happened today is we have Allbirds, probably a company that you know well out in San Francisco for all the tech bros wearing on their feet. Valuations fell massively for it. They get acquired, and today they announce that they're going to be an AI infrastructure, computing infrastructure company. Vinod, what's going on? What's all this about?
Well, from an investor point of view, there's too much of investors only bounce between fear and greed, and we are in the greed cycle. So whether you understand a business or not, investors want to get in. From Allbirds' point of view, my bet, and I know nothing about that particular investment, is they have a good management team, and that's what the investors are backing, and saying, back a good management team, and they'll make the right things happen. I think it's a lot more complex than that, but that's the situation, this bouncing between fear and greed. We will see a fear cycle too.
Fair enough. Can you walk us through what this cycle looks like, Vinod, then? What mistakes are being made if we're in the greed part of this cycle, and then how painful is the fear part of the cycle?
Well, I think all companies are being valued highly when 10 or 20% of them should be valued highly. So my bet is if I'm looking at 2030 backwards, 80% of these investments will lose money. The good news is the 20% that do succeed will make much more money. So most money will be lost. But more money will be made than lost. So by number, most investments will lose money, but absolute dollars, more money will be made. The discriminating investor who can pick between the right and the wrong AI startup will do much better.
80% feels painful. How painful will that be for your industry, Vinod? What does it look like after 80% of investments look like they don't deserve the valuations that they're commanding right now or go under?
Honestly, competent investors and incompetent investors are indifferentiable today. I think by 2030, we'll tell the difference between who made the right choices and who didn't. Most VC firms lose money. The median VC returns tend to be pretty bad retrospectively looking after cycles like this. But the best firms do much better than typical investment opportunities. We saw this in the dot-com cycle. We saw it in the 80s, we saw it in the 90s, we've seen it again and again. So I do think during frenzy times, and today is a frenzy time for AI, most investments 5 years later will look like bad investments, but the winners will be huge enough to make up for the losses for people who pick well.
And some of that frenzy perhaps is captured by this idea that the first quarter of this year, it was a record figure, according to PitchBook and others, for VC investing of capital being put to work. But if you strip out the 5 biggest transactions, we were actually down on the quarter. You know, this is an industry that was known for long shots, moon shots, basically defined by underdogs. Is that changing? Is this now an industry that's just trying to front run into the already existing big OpenAI and Anthropics of the world?
You have to separate low technical risk investments, which are all the data center investments, but they're large business risk investments, from what is traditionally venture capital, which is high technical risk. The number of opportunities where new things can be created is going up dramatically and offers lots of opportunities. The ones that require multi-billion-dollar data center investments, it's just a business risk people are taking. Frankly, if AI keeps growing as well as it has, they'll do well. If it slows down at all, they won't do well. But it's not really a technical risk, or even I don't consider it a technology investing if you're investing in data centers.
Hey, Vinod, before you go, because I know you've been very bold and out front to say AI is going to take something like 80% of jobs. So I just want to leave on this. When do you think we'll see the first AI VC fund? Are we going to get your industry upended by this too? Are we going to have investment committees completely being run by AI at some point?
Well, I think already people are experimenting with it. You will see all of these things. Well, the timing is hard to predict, but there's very few skills AI won't be able to do better than the typical human in that.
All right, Vinod, we're going to end things there. Thank you so much for joining us. We appreciate your time. Please enjoy the rest of the conference there. Vinod Khosla, founder of Khosla Ventures. Some punchy numbers, 80% of AI bets likely to lose money. Coming up, Bill Ackman's Pershing Square is one of dozens of companies preparing to come to market. The billionaire's IPO could raise as much as $10 billion. We're going to check in on the listings market next. This is Bloomberg Deals.
I'm Nora Melinda. Let's take a look at your midday movers. First up, the S&P 500 sitting right now at a record high. That rally being driven by optimism about a potential peace deal in the Middle East, with investors watching for confirmation of new talks alongside another wave of corporate earnings. In corporate news, bank stocks are in focus. Bank of America is moving higher after its stock trading desk delivered record results, helping drive earnings to their highest level in nearly 2 decades. Meanwhile, Morgan Stanley also posted a standout quarter, with its equity trading business bringing in a record $5.15 billion in revenue. And finally, Snap is on the rise. The stock is gaining after the company announced plans to cut about 1,000 jobs. That's roughly 16% of its workforce, as part of a push to reduce costs and move toward profitability. The CEO says those cuts, along with slower hiring, should lower Snap's annual cost base by more than $500 million by the second half of this year. Those are your midday movers. I'm Nora Melinda.
Let's get to some other big deals that we are watching this week. Bill Ackman has kicked off formal marketing for Pershing Square's combined IPO of its closed-end fund and hedge fund under the umbrella Pershing Square USA. The initial public offering could raise as much as $10 billion. It's expected to price on April 28th, according to terms seen by Bloomberg. And Bloomberg's Anthony Hughes is part of our IPO team and joins us now. So Ackman hitting the road.
Yes, so that's a large offering. It could raise up to $10 billion, but that's not really going to happen for a few weeks. And before then, we're going to see quite a few other IPOs. I mean, the Ackman vehicle is offering people the opportunity to invest in his closed-end fund while also getting shares in his management company. So it's a little bit unusual offering and a little bit more styled towards the retail audience, and that's where most of the demand's likely to come from there. But in the meantime, we're going to see quite a number of IPOs tonight. We've got Madison Air, which is going to be the largest IPO, which is likely to be the largest IPO of the year so far, raising $2.2 billion. And we've got 4 other IPOs pricing this week as well. So there's a bit of action happening before we get to Ackman.
So you have an HVAC company. I also saw a Madison Dearborn-backed drone maker also looking at an IPO. Is that notable that this is the type of company we're seeing defense and very like real world asset, the kind of halo asset type companies that are coming to market?
Oh, most definitely. I think, and the bankers like to say that the IPO pipeline's quite diverse, but I think you could argue, in contrast, you could argue that there's definitely some strong themes that are coming through here. Defense technology is one of the strongest. I mean, that's sort of related to space as well. And we've also got some biotech companies coming public this week as well, so that's coming back a little bit. But things are sort of basically coming together for the IPO market over the next few weeks, which just happens to be happening as the stock market has basically got over the Iran war to an extent, and the S&P 500 is back to near record highs. So things are sort of coming together, and there's a nice window here between now and Memorial Day when there's going to be quite a bunch of activity.
Have you heard any grumblings of any software-related companies? Anything that got pulled before that might be coming back?
Well, I think software remains a pretty difficult area for the reasons you've talked about extensively. So I wouldn't expect to see a lot of software IPOs near term. There is some talk that there will be some software IPOs, but I think they'll have to have a very strong AI story and really be able to answer a lot of tough questions about this disruption posed by AI.
All right, Anthony, thank you so much for joining us. That's Anthony Hughes of Bloomberg on the IPO team. Up next, deal-making persisting despite war-driven disruption, especially in energy. Our investment committee today takes a closer look. This is Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. Let's head over to Scarlett Fu, who's been taking a closer look at M&A in energy. Scarlett.
That's right. Energy companies, Danny, may be this year's stock market darlings. They're topping returns in the U.S. and around the world, but their deal making has not necessarily kept pace. According to Bloomberg data, almost $70 billion of deals are pending. That's down 6.5% from the same time a year ago. Even when you exclude renewable energy, transactions involving just oil and gas companies are largely flat from 2025. And one big reason, the U.S. and Israel's war in Iran. It's damaged energy infrastructure in the Gulf region, choked off oil flows through the Strait of Hormuz, and led to a surge in oil prices. Now, the industry's 2 biggest announced deals came in February, before the war. Devon Energy acquiring Coterra to create a massive shale giant for about $24 billion in equity, and deepwater oil rig owner Transocean, right here, buying its rival Valaris for $5.5 billion in equity. Now, in the end, this conflict may just delay rather than kill potential deals. You look at Kuwait Petroleum, for instance. It still hopes to raise up to $7 billion by leasing part of its pipeline network, with names like GIP, Brookfield, and KKR reportedly among the interested bidders, while Saudi Aramco looks to sell a stake in its oil export and storage terminals in the coming weeks. So more deals to come eventually when things get going.
Scarlett, thank you so much. And we're going to discuss exactly that. What deals are going to get going when this market calms down? And it's this week's investment committee where we take you into the boardroom debates in real time. On today's IC, it's David Carnevale, a deals reporter who specializes in energy, with us here at Bloomberg. Dwight Scott, executive vice chairman at Quantum Capital Group, an energy-focused private equity firm, and Lande Spottswood, partner for M&A and capital markets at Vinson and Elkins. Thank you all for joining today. Dwight, I have to start with you because You're known really for building up Blackstone's credit business into a behemoth. And I wonder how many people know that before that you actually got your start in energy investment banking. But for you to join Quantum, you must have seen a very large opportunity of scale and size. So what is that opportunity for you?
Well, first of all, thank you both for having us here. And Lande, I look forward to having this conversation. When I look around the world today, there are a lot of different asset categories that have been fully capitalized. There are a lot of flow that's gone into large cap private equity, other places like that. Energy has really fought that trend. And I think what's getting ready to happen, like take Upstream for a minute. Upstream, every day we see a new article that shows how critical upstream assets are to the economy. You hear about data center development, AI development, what's happening with national defense, electrification of the economy. We're proving every day that having a robust upstream business in your market is very important, and it's undercapitalized. There's only 4% of the S&P 500 in upstream, and that was 15% 15 years ago, 25% 40 years ago, and even in the private markets where we compete, where there were 70 competitors that could go buy upstream assets 10 years ago, today it's 10. Right. And so you have an undercapitalized asset that needs to spend capital. The forecast is $1 trillion a year to drill wells worldwide over the next 15 years. So you need capital, you're undercapitalized, and you're cheap. So they're trading at 6 times EBITDA. That is, compared to any other asset class in the market, very cheap today, and the private markets trade at a discount to that. And then you add one more thing. The risk is coming out, particularly in the US. As the basins mature and as the shale plays, you get more and more data. So Quantum, for instance, is investing in 1 out of every 4 wells drilled in the US today. So we get a lot of data. And you see where the wells are being successful, where the costs are coming down, and you can invest around that. So you have a critical asset that's cheap, that's undercapitalized, and that risk is coming down. And so I think that's going to be a place where we raise capital in the future and we find good opportunities to invest.
Lande, are you seeing similar drivers for deals happening right now as well?
Well, we are. But I think right now, when there's so much uncertainty about what crude oil prices are going to be 12 months from now, deals can get done in uncertainty. It's hard for them to get done in uncertainty that there's a reasonable belief that might be resolved in the relatively near term. And I think there currently is that. So I think that's what's slowing down deal activity right now. In terms of capital, I couldn't agree more with Dwight. We really have seen there be less capital raised to go out and make these investments in U.S. upstream and oil and gas. And there's just a lot more dry powder in other places right now. And so I think we do need to see more fundraising to go out and invest in upstream to really see a lot of increase in deal activity there.
So, Lande, to follow up on that, I mean, you're based in Houston, you work with oil and gas companies, many of them are public. I wonder how the mindset of companies is shifting in this new reality when it comes to deal making. It is my sort of impression that the deals that we've seen before the war, it was a bit of a Hunger Game type of situation, like fighting for survival, right? Creating scale, creating synergies, with oil price at 60 and the outlook not being so great. That was kind of the mindset. How is that shifting, right now? I mean, what are companies telling you when it comes to the rationale for doing deals in this new reality?
I think that the long-term rationale is the same. If you're a big publicly traded or mid-sized publicly traded oil and gas company, what these companies want to do is continue to grow cash flow. And if they can't keep doing that through organic acquisitions, through being the buyer, they feel like ultimately you're going to get smaller unless you're growing. And so that kind of pushes people towards looking at a merger where they're merging with a merger of equals or merging into a larger company. So I think that there still is this general push for consolidation because of that, because it's an asset class that very much you sell a little piece of your business every day. And so you need to be growing, or you've kind of reached the end where now it's time to maximize value for shareholders by selling.
Just putting all this together, Scott, I'd also love to get your thoughts on what this current volatility means for deals that you're looking at. Obviously, there's a lot, especially in upstream, that's attractive to you. But when you see energy prices that are either, one, volatile, or two, to Lande's point, this big question mark over what it looks like in 12 months from now, how does that impact what you're doing?
Yeah, I would agree with what Lande said about the public companies. Sometimes this volatility causes you to step back if you're a public company because your price is moving around. Private markets, so Quantum's been doing this for 30 years. We have seen these cycles come and go. You make cautious investments, you hedge them appropriately, you make sure that you have an exceptional management team that can take that asset and grow it to the next level and then sell it to a buyer who sees that growth. And so you don't overreact to these moves in the market. And I'd say that's true across the private markets right now. We're seeing good opportunities. There's not a step back right now. And nobody's rushing to the exits. Back to one of the things you said, the market's not rushing to the exits here because these are long-term assets. I will say I do think that what's happening in the Middle East may reprice the bottom for commodity prices up a little bit, which may impact value long-term.
So, Dwight, just in terms of one trend that we've been seeing is these public companies optimizing their portfolios and selling packages. I wonder what's the sentiment in the market around those opportunities right now? Because, of course, you know, what I'm hearing from my sources is that it's very hard to price assets in this environment. So I wonder whether some of those processes are on a holding pattern or, you know, sort of waiting to launch to have more visibility on oil price at this point.
Well, I think what's happening with the public companies is ultimately interesting in the private markets because as these public companies merge, some of the assets are less impactful to them and they divest of those. That's why you're asking the question. I think that will continue to be true, and they're not as price sensitive as to where that goes. They need to clear that out so they can invest in their core assets. And as prices go up and the cost to drill go up, they don't have the cash flow quite yet, so they're looking for other sources of capital to go drill in the Permian if that's where their core asset is, or some other market. So I think it's going to continue. We'll continue to see flow there.
Well, I think talking about a deal that was mentioned before on the show, Coterra Devon, is one of those mergers that is going to sort of shake up as a portfolio optimization opportunity down the road. I think there's going to be plenty of opportunities for your firm to scoop up from that merger for sure.
And I do just wonder, by the way, speaking of other deals that have been happening, not in energy at all, but United CEO floating the idea of a merger with American. It feels like everything is on the table. Lande, is that the case when it comes to regulators, that we could be talking about two oil giants merging together and maybe regulators would be okay with that?
Ooh, so I do think that this is a time when it will be more idiosyncratic in terms of what really large mergers get through. In terms of energy, it's actually, particularly upstream oil and gas, which we've been talking about a fair amount, it's not a sector that really has a huge competition lens to it. What we feel like it does, because under the prior, in the Biden administration, we had a lot of big oil and gas deals that got held up in second request for a very long time. But if you look at how those were resolved, they ultimately didn't find any actually competitive concerns with the mergers of Chevron and Hess or the merger with Exxon and Pioneer. What they ultimately did was negotiate settlements that involved the CEOs of, or the chairman of the targets not going on a combined company board. So there were a variety of transactions where, very big transactions that actually, even in the prior administration, they didn't find competition issues with. And so I think that you have a lot of room to merge upstream without running into those. And I think this administration is friendlier to bigger companies and friendlier to energy.
Well, I'm excited to see what might come out of this year. Yeah. Unfortunately, we're out of time, but you both need to join us again alongside David. Thank you all so much. Wonderful to see you all. That's today's Investment Committee. Bloomberg's David Carnevale, Dwight Scott with Quantum Capital Group, and Lande Spottswood with Vinson and Elkins. Up next, private equity player Thoma Bravo is making some big moves in tech. We're going to break it down with senior partner at the firm, AJ Rohde. That's coming up next right here on Bloomberg Deals.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, the S&P 500 is on pace to close at a record high. That rally being driven by optimism about a potential peace deal in the Middle East, with investors watching for confirmation of new talks alongside another wave of corporate earnings. In corporate news, JP Morgan plans to raise at least $7 billion from an investment-grade bond sale. The deal comes as renewed optimism over the potential Middle East peace deal has lowered borrowing costs and drawn borrowers into the U.S. IG market this week. Elsewhere, Robinhood, Webull, and eToro are climbing after the SEC approved a plan to remove $25,000 minimum equity requirements for day traders. TD Cowen says such a reduction may boost retail engagement and trading, particularly in cash equities and likely options. And finally, ex-sneaker maker Allbirds is skyrocketing more than 600%. That's after the company announced a new business plan for AI computing infrastructure just before it planned to close down for good. The firm plans to change its name to New Bird AI and has secured $50 million of financing. Those are your midday movers. I'm Nora Melinda.
This is Bloomberg Deals. I'm Danny Bergerman. I'm still not over that Allbirds story. Hopefully we can get into it a little bit with our next guest. But first, a deal to cover engineering software company Nemetschek agreeing to buy construction management platform HCSS from Thoma Bravo, a deal valued at over 2 billion euros or $2.4 billion. Thoma Bravo will take a 28% stake in part of Nemetschek to help absorb HCSS, called the build segment. Joining us now is AJ Rohde, senior partner at Thoma Bravo, who oversaw this deal. AJ, great to see you. Look, it's a time when everyone's wondering, can you sell a software company at a good price? Is this sector in absolute turmoil? So why sell HCSS? Why was now the right time?
Great to be here, Danny. Thanks for having me. Can I say software deals are back? Is this the right time to say that?
I think you're the leading voice on it, so if it's back, you tell us, AJ.
Yeah, it's exciting. We had an opportunity to merge our company with Nemetschek, take a significant stake in their company. This deal's a year in the making. You know, I'm honored that we got to partner with a great family-controlled, founder-controlled German company. We've actually done this before with another family-controlled German company recently called Heidelberg Materials, for another portfolio company called Command Alcon. So we had some experience with the joint venture concept in these large transformational investments. And so we're going to bring our expertise, our operational expertise, our SaaS, our AI expertise. And in this case, it's a design and product-centric company. So we're just so happy to bring the two together. It's going to be a really important merger for the industry.
I know when you talked to our reporter, Crystal C, about this story, a quote stood out to me. You saying essentially that the PE market is confused about software. Is the idea there, AJ, basically that some people are exiting software just because there's stress and there's liquidity and not because that they've actually grown and created value in the company?
I mean, look at the performance in some of these prints in Q1, and I'm sure you're going to see more good news coming out of that. But those companies that were ahead of this, Danny, to start to bundle generative AI years ago and agentic in the last couple of years with deterministic execution systems and SaaS are doing really well. That's our portfolio. We've been ahead of this. So we've never performed better in the fund. It's kind of interesting that, you know, we're seeing this outflow of capital and continued to happen, although some of the days are better than others. But I would say we're experiencing unbelievable growth in the portfolio. And, you know, the company I merged in is growing 21%. Build and construct for Nemetschek's growing in the mid-20s. This was a mid-20s EBITDA multiple deal. This is a healthy, great space, great companies. I mean, this is a symbol that the market's still very good.
I mean, it's remarkable to hear, AJ, just given all of the stress. I wonder do LPs feel the same way? And what about financing markets? Are they open in the same way that they once were? Again, given all the concerns about AI and software?
We have the best LPs ever. So we had them all in Miami 3 weeks ago. And they were like, whatever you're doing, keep doing more of it. Go faster, break more glass, put more agents, put more generative AI in, and build scale and build account control in your best portfolio companies. So we have a hugely supportive LP base. We love it. We are absolutely buyers of whatever we can, of franchise leaders that we can partner with existing management right now. The financing markets are holding better than maybe the headlines would suggest, particularly in the mid-market. Up-market, probably a little bit more challenging, but still a very active market for software financing right now, particularly for those companies that have figured out AI pretty well.
By the way, AJ, I know this is not exactly your expertise. I don't think it's anyone's expertise about shoe companies converting into AI companies, but I just have to ask you, because you and the folks at Thoma Bravos are masters in building up companies and changing different directions. Allbirds, which you probably know there in San Francisco, is the one that a lot of tech bros wore, now becoming Newbird and an AI computing infrastructure company. I mean, AJ, are we just like at a moment of frenzy in this market around AI?
That's kind of a bubbly kind of thing to hear, I would say. I can't comment on what actually they're doing. There are a lot of companies with a lot of data assets, infrastructure assets that are hard goods, consumer goods, completely unrelated to technology, that might be thinking about how do I monetize those assets and get paid for those assets in a modern world with digital infrastructure being so valuable. So I'm not sure what that headline was, Danny, but like that's an example of companies maybe being creative.
Hey, AJ, I'm pretty bummed because I'm out of time right now, but you're awesome. This has been awesome. Please come join again soon. This has been way too short. I have so many more questions I want to ask you. AJ Rohde, senior partner
Thanks
at
for having me,
Thoma
Danny.
Bravo.
Good to see you.
Thank you, AJ. All right, coming up on the show, over 1,000 Hollywood writers, actors, and directors signed an open letter opposing Paramount's takeover of Warner Brothers. Bloomberg's Lucas Shaw joins us next to discuss right here on Bloomberg Deals. You are watching Bloomberg Deals. Danny Berger here alongside Scarlett Fu. More than 1,000 Hollywood actors, directors, and screenwriters have penned a letter opposing the $110 billion takeover of Warner Brothers by Paramount, citing concerns about job losses and higher costs with fewer choices for consumers. Bloomberg's Lucas Shaw joins us to discuss the story. And Lucas, I mean, you're looking at images of some of the actors here. It was a who's who of people opposing it. Does it make a difference?
TBD. Probably not. This is a legal matter, and it seems like the Department of Justice is not going to aggressively fight this merger. Some state attorneys general, Europe may, but most people assume that will lead to kind of minor concessions, not to the deal getting blocked. But the Hollywood industry is against this deal for the most part. There are exceptions to that, and I think they are hoping that if they apply enough public pressure and rally enough opposition, that it may, if not completely derail the deal, impede it a little bit.
And we are expecting Senator Booker apparently hosting today a hearing on the Warner Brothers deal. Mark Ruffalo among those testifying for it. What sort of reception are they likely to get in Congress?
Well, I think the senators on the left, the Democratic senators, will probably be generous and friendly towards the Hollywood figures. They are the ones who are raising concerns about this deal. You'll remember that the Senate held a hearing on the Netflix deal with Warner Brothers earlier this year, and there was more bipartisan skepticism. This time it seems like the Republicans aren't as interested in questioning this deal, but the Democrats still are. I think the bigger question is whether this hearing, which isn't even a full hearing, is going to matter or make a lot of noise. David Ellison is not attending. He said that he's attending a funeral for a relative.
So what about internationally, Lucas, in Europe, in the UK? Is there any sort of pushback that international lawmakers are giving into these two companies?
I mean, there is some. Both Paramount and Warner Brothers Discovery have significant assets in Europe in particular. And so I think there's concern in select markets about how much power that company could have. Again, I don't know that will derail the entire deal, but it could lead to concessions of selling particular networks or assets in the region.
All right, Lucas, thank you very much. It'll be very interesting to see how this one evolves. Again, a hearing, as Lucas points out, it's not a full hearing. Set for today, Senator Booker holding that one. Mark Ruffalo is apparently going to be speaking at it, and along with that open letter from various Hollywood actors. Lucas, thank you very much. And that does it for today's edition of Bloomberg Deals. A lot on AI to chew over, and that Allbirds AI company thing may be a sign of greed, as Victor Khosla and AJ Rohde from Thoma Bravo told us, a sign of the times. To stay up to speed even after the show, subscribe to the Bloomberg Deals newsletter. That's it for us here at Bloomberg Deals. See you same time, same place next week. Up next, though, Balance of Power, live from Washington. You're watching Bloomberg TV.